Today, we will discuss the tax ramifications of the liquidation of a Subchapter S entity. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the firm Cummings and Cummings Law. I also teach business law at Florida Gulf Coast University and hold 4 degrees, including 2 law degrees, as well as a variety of tax, financial, and accounting credentials, which I apply for the benefit of my clients in my practice of law. Our firm website is www.cummings.law. At the outset, it is worth noting the confusion surrounding Subchapter S terminology. I frequently speak with owners of small and medium sized businesses who confidently tell me that they have a limited liability company or a corporation, and then look at me as if I'm speaking Greek when I ask if they have a Subchapter S election in effect. Normally, they reply something to the effect of, no, it's an LLC, or no, I just told you, it's a corporation, failing to grasp the difference in legal entity versus tax treatment. This confusion is compounded by the fact that many attorneys and CPAs routinely file Subchapter S elections on behalf of their clients without adequately explaining the effects, legal, practical, short term, and long term. Therefore, in the interest of clarity, when I refer to a Subchapter S entity in this video, it is important to understand that that entity may be a corporation or limited liability company, as confusing as this may sound. Now, with that in mind, we will discuss the tax effects, or at least some of the effects, of a liquidating distribution of a Subchapter S entity, which again may be a corporation or an LLC. A complete liquidation of an S entity is not merely closing the doors. It is a legally and tax significant process in which the corporation ceases business, winds up affairs, sells or distributes assets, pays creditors, and makes liquidating distributions to shareholders in redemption and cancellation of all stock. For federal income tax purposes, sections 331 and 336 treat liquidation as a sale or exchange by shareholders and a deemed sale of assets by the corporation. Tax consequences arise at both levels, and assumptions that S entities cannot trigger entity level tax are often incorrect, especially in this circumstance. Documentation is, as always, critical. Corporate minutes or consents adopting a plan of liquidation, creditor notices, and consistent reporting must substantiate liquidation. Liquidation may occur over several distributions if the plan permits this. Informal wind downs without a formal plan can undermine tax positions, distort timing, and increase audit risk and ambiguity. A corporation in liquidation is treated as if it sold assets at fair market value immediately before the distribution. Section 336 taxes built-in appreciation at the corporate level, and S entities with prior C corporation status may face the Section 1374 built-in gain tax during the 5-year recognition period. Certain ordinary income items, such as depreciation recapture, amortization recapture, and inventory, retain character and flow through on the final Schedule K1. Distributing appreciated property without sale can still trigger gain. Therefore, accurate valuations and recapture calculations are indispensable. Under Section 331, shareholders treat complete liquidating distributions as received in exchange for stock, recognizing capital gain or loss equal to the amount realized minus basis and subject to certain other modifications. Special rules such as Section 1244 can render qualifying losses ordinary in certain circumstances. Liquidating distributions are not governed by AAA rules, rather, basis still determines gain or loss. Owners should reconcile basis with their final Schedule K1 to avoid mis or under reporting. Shareholder assumption of liabilities generally reduces the amount realized. Debt settled for less than face value can, however, create corporate level cancellation of debt income. Exclusions under Section 108 can also apply at the corporate level. Recourse versus non-recourse debt, collateral, and state law may also influence outcomes. Forgiving debt or abandoning balances without adequate and formal documentation can also give rise to audit risk and recharacterization exposure. S corporations with C corporation history, as I mentioned earlier, may face the built in gains tax on appreciated assets sold or deemed sold during the recognition period. Depreciation and amortization recapture often produce significant ordinary income, much to the surprise of the owners. Inventory yields ordinary income on disposition, as you might expect. In any event, a detailed asset by asset analysis is imperative to avoid mistakes. Section 453H can allow installment obligations to be distributed without immediate gain recognition, with shareholders continuing to report payments as they are received, though strict compliance with applicable rules is required. Stock basis, as you would expect, determines shareholder gain or loss. Suspended losses may be released if basis is restored prior to liquidation, or at least before the liquidation is completed. The final Schedule K1 must, in any event, reconcile capital accounts with basis liquidation proceeds. Form 966 must be prepared and filed with the Federal Internal Revenue Service within 30 days of adopting the liquidating plan. The final Form 1120S, which is often a short year return, though not necessarily so, must be marked final and accompanied by the final Schedules K1. Liquidating distributions are reported on Form 1099 DIV. Final payroll, informational, and state tax filings may also be required, and failure to comply prolongs liability for the business and its principals. State conformity to federal tax law varies tremendously. Dissolution often requires tax clearance certificates, and failure to obtain these certificates can leave entities and their owners liable for ongoing liabilities. Frequent errors made in the dissolution process include assuming erroneously that there is no entity level tax, believing property distributions avoid gain, misapplying AAA rules, ignoring liability treatment, and falsely assuming that installment deferral automatically qualifies for favorable tax treatment when that is not always the case. Finally, and to summarize, a disciplined plan begins with board approval, Form 966, asset disposition, liability satisfaction, and final distributions, followed by final federal and state filings. It is critical for principals to retain detailed records, ideally beyond statutory minimums. Planning opportunities such as timing asset sales, electing installment treatment, or deferring built-in gain tax may be available, but always require the input of a professional who is frankly experienced in this area. Again, my name is Chad Cummings, and I hope you found this information useful. As always, the information in this video is general in nature and is not legal advice, because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my other videos, please visit my firm website at www.cummings.law to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.